This is the study session on equity investments and the reading on overview of equity securities. And this really is an overview. We're going to talk about some basics. There's going to be lots of good definitions, but the LOSs use the words describe and distinguish. So we're going to have lots of that. Let's get to that first LOS. There you go. Describe characteristics of types of equity securities. Notice that total equity market capitalization is nearly $100 trillion, and this is about a year ago. Note that the U.S. accounts for just a little bit over half of that market capitalization, with the other developed countries and economies leading the way. How about some characteristics of types of equity securities? Let's first talk about common shares. I mean, most companies have just regular old common shares. Notice I got the word ordinary in parentheses there. And so let's go back to what a business does. We learned this back in our corporate finance study session. So what does a business do? They regularly borrow money. So they issue bonds, and the executives of these companies make an explicit promise to the bondholders. I promise to pay you interest and I promise to pay you principal. And then those same executives, they issue shares of common stock, and they make kind of a vague promise. They say something like, hey, you know what, if we do really well, we'll pay you a dividend. We don't have to pay you a dividend, but we'll try to pay you a dividend, and then you can generate a capital gain in that supporting secondary market. And so the executives, they raise all this capital, they invest in positive net present value projects. And those positive net present value projects, they generate a profit right on the bottom of the income statement. But as good financial analysts, we know that what's more important is how much cash flow is being generated. All right, so what happens is then that the shareholders, the owners of the business, they have a claim on that cash flow that is generated by the assets. So what do I have written in the bullet points there? Of course, it's evidence of ownership. Common shareholders own the firm. It's on the bottom right-hand side of the balance sheet, so it's long-term financing. And part of that vague promise is that the shareholders, they get what's ever left over after all of the people above them on the right-hand side of the balance sheet are paid. Right? There's accounts payable, and there's notes payable, and there's taxes payable, and there's maybe preferred dividends. So after all those people get paid, what's left over, we call that residual amount. That's why a common stock is known as a residual security. You get to share in the profitability of the business. Now, of course, what goes along with that is that as an owner, you have the right to direct the future of the corporation. Now, that doesn't mean you can walk into the company and say, hey, I think we ought to be doing this. Now, what that means is that you have a right to vote for the board of directors. And remember, back in our corporate governance readings, we talked about the importance of the board of directors in establishing the strategic long-term plan for the business. So the shareholders have a say, they have input in the strategic long-term plan of the business by participating in the annual election. How about different types of securities, of equity securities? Let's start with the common shares. What does this typically mean? It typically means that when you own one share of stock, you get one vote. And this is called statutory voting, where each share represents one vote. Most firms have statutory voting, but some firms have what's known as cumulative voting. What that means is that if you own 2 shares of stock and the company is electing 2 board of directors, what you can do is, instead of voting 1 share for one board member and 1 share for the other board member, what you can do is you can aggregate those. You can sum your shares. You have 2 shares and you can vote them for a single board member. And of course, you're invited to the annual meeting as a shareholder. You get this proxy statement in the mail. It says, Dear Mr. or Mrs. Shareholder, please attend our annual meeting. It will be located at our headquarters, wherever the headquarters is. By the way, here's the agenda. We're going to vote for these particular board members. And you can go to the annual meeting and vote, or you can fill out the little slip of paper and put it in an envelope and mail it in. Or if you do like my mother used to do, she would get this in the mail and she would just toss it right into the garbage can. And when she did that, she gave somebody else the right to vote her shares by proxy. Now, most corporations have just really one class of shares. So if you look on the equity portion of the balance sheet, you'll see that, it'll say common stock and it'll say par value and then maybe paid in capital. But some companies have different classes of equity securities, Class A and a Class B. Now, I don't want you to get this confused with the different classes for mutual fund investments. That's a completely different story. Here, the main difference between Class A and Class B shares is how they treat voting rights. So Class A typically is the voting stock and Class B is the non-voting stock. Almost always, the only difference between those two is in the treatment of the voting rights. A good example is the Ford Motor Company. On the floor of the New York Stock Exchange, we're trading the Class A shares, but the Class B shares are owned entirely by the Ford family members. And so they have all of these shares that don't have any voting rights, but those family members, they have a small percentage of the Class A shares. Now, there are also these things called callable and puttable common shares. These are not very common, but they're really, really cool things. These are known as securities that have embedded options. A callable common share gives the owner, it gives the issuing company the right, but not the obligation to buy back those shares from the investors at a predetermined price. Now, this almost always happens in the parent versus the subsidiary game, where the parent would like to have the option to repurchase shares of the subsidiary. But that callability, that call option inside of this common share, gives it some really, really interesting characteristics. And we're going to talk at length about derivative securities in that particular study session, and that's going to be super fun. Now, puttable common shares are kind of like the opposite. It's not really opposite, but maybe it's a flip side of this. What this does is this gives the investor the right, but not the obligation, to sell the shares back to the issuing company at a pre-specified price. So notice that under a callable common share, the issuing company owns the option. Under a puttable common share, the investor owns the option, owns that embedded option. And the reason for puttable common shares, which are not very commonly used, but the reason would be to make a common stock more attractive, meaning that the shareholders are willing to pay more to get a minimum price at some time in the future. I mean, think about this. If you had a puttable common share and you paid $100 for that common share, you may have the right to sell it back for, pick a number. It could be 90, it could be 110, it could be almost any number. But suppose that company goes bankrupt and the stock price falls to zero. Well, then you have some ability to get some of your money back. How about preferred shares? Preferred stock is similar to common stock in that it is located in the equity portion of the balance sheet, but it's also similar to long-term bonds because common shares they don't have to, but they tend to pay a fixed dividend. So a lot of times preferred shares are known as a hybrid security. It's part of ownership, but preferred shareholders don't have any voting rights and they don't share in the company's operating performance. Typically, the preferred dividends are higher than the dividends on common shares. And there are a couple of variations of these preferred shares. There's cumulative preferred shares, in which if you're the shareholder and you don't get a dividend for some reason, well, they accrue and you have to receive those dividends before any dividends can be paid to the common shareholders. And then non-cumulative is just the opposite. Participating preferred shares, this is a little bit of an interesting animal because what it allows the preferred shareholders to do is to kind of participate in the operating performance of the business, not to the extent that the common shareholders do, but maybe if the company does really well, the participating preferred shareholders will receive their regular fixed dividend plus something else. Non-participating, that of course is just the opposite. And then here's another one of these embedded securities that have embedded options, a convertible preferred shares. Imagine this. If you own preferred shares, you own the option to convert those preferred shares into common stock. And you would only do that, of course, if the company is doing really, really well. All right, how about private versus public equity? Of course, what do we know and what we've been talking about in this study session are publicly held companies who've gone through an initial public offering and then maybe a seasoned equity offering, and then their shares are traded on a secondary market, like the floor of the New York Stock Exchange. Private placements, these private securities, are not listed on public exchanges, and so there is no secondary market. I should say there's no active secondary market. And these can be, they don't have to be, but they can be highly liquid. And typically what's happening is that probably you or I, no offense to your personal wealth or my personal wealth, but probably you or I don't have enough capital to participate in a private equity issue, but institutions do. And so banks and insurance companies and pension funds and mutual funds, they're always interested in private placements. And typically what that means is that the shareholder of this private placement, this private equity placement, then is in it for the long term. All right, types of private equity investments. Let's start with venture capital. And there's the stages of the venture capital process. You start with some seed money, and then you have some startup money. And so that seed money is really just a reward for having an idea. Oh, I have a great idea to do something, whatever that product is. And so they develop the idea and come back and say, okay, for me to actually put together a project, I need this and this and this. These are typically assets. So then there's some startup fees, startup costs. And then if the product looks like it might be successful, then there's expansion, and then there's a bridge stage, and then the final buyout stage. And so what does the venture capitalist want to do? They want to buy low in the seed stage, and then they want to sell high in the buyout stage. All right, so what do I have in the bullet points there? Funds made available for startup firms, that's right. Financial support to young, rapidly growing companies or individuals. How about a leveraged buyout? This is a transaction whereby the target company management team converts a publicly held company into a privately held company. And it's called a leveraged buyout because the use of leverage is required. Leverage, of course, means a bank loan or a bond issue. And so there's no way that a management team could ever do this if in fact they didn't have the capacity to issue a bond or borrow money. And there have been some tremendously successful leveraged buyouts over the years, but there have also been some really terrible, awful disasters. There was a company in Texas, a natural gas company in Texas about 10 years ago that was taken private. I think it was $45 or $50 billion, future holding company. And this was right before fracking became really popular and really profitable. And so I think this company lost all its money, and they declared bankruptcy pretty shortly afterwards. Private placement, these are shares that are not sold through a public offering, but through a private offering. And these are probably chosen investors. These are probably institutions. How about this LOS? Describe methods for investing in non-domestic equity securities. I mean, you can do this directly. I mean, let's take the long route in describing this process. Let's suppose that you wanted to invest in a German auto manufacturing company. Well, what do? You get on an airplane and you fly to Munich, and when you get off the plane, you have all these dollars in your pocket. And so you go to the financial institution and you convert you convert those US dollars into euros, and so you have these euros. So then you go to the stock exchange and you get in line and you buy shares of stock of this German auto company. Then you get on the plane and you come back home. I mean, of course, that you would never do that, but you can do this directly in foreign markets. On the other hand, you know that the investment banking industry is going to try to make it easy on investors to do this. So they created these depository receipts. And it looks and acts and behaves exactly like a share of stock, but it's created when the equity shares of a foreign company are deposited in a bank, and then they issue these receipts. That's kind of why it's called a depository receipt. And then they're traded on the floor of the New York Stock Exchange or any other kind of an exchange. So here's a good little flow chart about how this works and different kinds of participants that are needed for a successful investment in non-domestic securities. There are also global registered shares, and these are common stocks that are traded on different stock exchanges around the world. I mean, it makes sense for a company like Johnson & Johnson or Microsoft. They're probably popular throughout the world, and so different exchanges want to participate in this. And so this, what happens here is that there's more flexibility with these registered shares than with the depository receipts, and so it's traded on multiple exchanges. You know, one of the interesting things about this is that if you don't like the price of Apple in the NASDAQ market in New York, you can go somewhere else and see if you can buy it in Japan or in Europe or maybe even in the North Pole. I mean, wherever you can go to trade for it, that's where investors will go. And then there are these baskets of listed depository receipts. And so what you're doing is you're just buying a diversified portfolio. Here's our first compare. Compare the risk and return characteristics. All right, so we've done this before in a previous study session. What we're going to do is we're going to calculate really just the holding period return, which is the capital gain. So there's the price today minus the price yesterday divided by the price yesterday. There's the capital gain component of it. And then you add the dividends in the numerator to get the income component. So right, there are two sources of total return for equity securities: capital gains and dividend income. Now, what's the difference between the levels of risk for these kinds of securities? Remember that common stock, which is located on the bottom right-hand side of the balance sheet, since it's considered a residual security, it has to be the most risky of any of those securities that you can purchase that are issued by a company. So common stock is considered to be riskier, and in fact, sometimes it's considered to be much riskier than preferred shares. The cumulative preferred shares have less risk than the non-cumulative preferred shares because they're going to have the right to receive any missed dividend payments. Puttable shares are pretty secure, and then the issuer can redeem callable shares, which puts more risk associated. The investor is going to pay less for a callable share. Here's a great question. How do shares help in company financing? And I'll just remind you that we talked about this back in our corporate finance study sessions. I mean, what are we doing here? We know that corporations, we know that businesses regularly borrow money. What do? They issue bonds and they issue shares of stock. And so here's the great thing. Remember, we talked about the supporting role of the secondary market for the primary market. So what companies do is they can raise capital to invest in positive net present value projects. Now that could mean funding an expansion, that could mean boosting liquidity, that can mean a variety of different kinds of projects. But what's the important thing? They raise capital quickly. A company doesn't want to say, oh, I need $1 billion and let me get it in another month or 2 months or 5 months. No, the businesses, when they have positive net present value projects, they need to invest that capital today, because if it does not, the competition is going to come in and steal that market share. Now, equity financing is used lots of times to finance acquisitions, and it's also used to provide some good benefit packages to employees. And then finally, and think about a financial institution like a commercial bank that has lots and lots of liabilities on the top right of its balance sheet and maybe just a small amount of equity. And so equity financing helps improve capital adequacy ratios, or to make certain that the covenants that are in the bond contracts are met. Look at that bottom line there. Once the shares have been issued, the overall goal of the firm must be to maximize shareholder wealth. You hear me say that pretty regularly throughout these videos. What's the goal of the business? Maximize shareholder wealth. How do we do that? Well, we try to issue bonds and issue shares of stock at the lowest possible interest rate. How can we do that at the lowest possible interest rate? By investing in projects that are going to generate lots and lots of cash flows, not just today, but also tomorrow and next decade. How about market value versus book value? The LOS asks us to distinguish between the two. Market value is really just the value on the floor of the New York Stock Exchange. So you have a price on the New York Stock Exchange, and then you multiply that by the total number of outstanding shares, you get the total market capitalization of the business. Book value, on the other hand, can be very different. And what it is the book value, the accounting value, book value of equity, is the value of the firm's assets minus the value of the firm's liabilities. All right, so remember that fundamental accounting equation: assets equals liabilities plus equity. If you subtract equity from both, if you subtract liabilities from both sides, you get the formula for book value. Let's see, we did this return on equity formula back in our accounting study sessions, right? And so all we're going to do, profitability, return on equity, we got some measure of return in the numerator, we'll call that net income, and then some measure of equity in the denominator, and we're just going to take an average of current equity and the previous equity. All right, so why is this return on equity such an important metric to evaluate the performance of the executives? So what do we take out of this? Return on equity is going to go up from a mathematical standpoint only when income is increasing at a faster rate than shareholders' equity. So think about, from the accounting standpoint, what happens on the bottom right-hand side of the income statement. We take that net income and we swing it back over to the retained earnings portion of the equity. All right, so what do we want? We want that equity. We want that net income from the income statement when it comes back over there to continue to come back, right? We want lots and lots of income switching over to equity. And then, of course, a negative sign is just the opposite. How about this concept here? What is the company's cost of equity, and what is the company's required return on equity? And so let's make sure you understand the difference between and among the three. Let's go back here. This return on equity is an accounting profitability ratio, okay? The required rate of return on equity is the minimum return that the shareholders agree with the executives when providing them capital. I always say this, and you guys have seen me do this in a video. The shareholders say to the executives, hey, we'll send you some money, but by golly, you better pay us 10% or 15%. That's the required return on equity. And then that becomes, from the other perspective, that becomes the cost of equity from the executive and the firm's standpoint. Let's take a look at a quick example. Let's calculate the return on average equity. And we're given some details in last year, 2018, and this year, 2019. So all we're going to do is put that net income, 4518 in the numerator, and then take the average of the total equity, which is the 20,000 and the 19,000. Take the average, and there's the return on equity, 22.62%. Now, let's go ahead and use some similar data and compute the total market value of this firm. So all we're going to do is take that stock price from 2019 of $18.40, multiply it by the 4,000 shares, and there's the total market cap for this company. Now, how about let's calculate the book value per share. So what we're going to do is at the end, we need to first calculate book value per share, and then we'll do the price to book ratio. So we're going to take that total equity, 20,223, divided by that 4,000. So we get a little bit more than $5 in book value per share. Use that in the denominator with the 1840 in the numerator, and there's the price to book ratio. And that takes us through an overview. So this really was an overview, not too many particulars. I did some calculations in there, even though we probably didn't need to do that, just to give you a sense of how to apply these describe and definitional LOSs. We'll talk about industry and company analysis next time.